Do you ever, like every so often, see something, read something, watch something, and it just makes a big impact, total clarification on what something is or should be? I know that's a big question, what have you. You most likely will all do. Well, today I was watching the guys at hedgeye.com. This is a research firm that provides information for a fee. And what I have learned from this group of people, this company, is process-driven investing. Okay, these guys have got this dialed in. And today, Keith McCullen, who is head of Hedgeye, who is started Hedgeye and invented the process that they use to invest, shared with the subscribers this chart about the relationship between U.S. dollars and U.S. debt, and how one of them is a leading indicator to the other, which then opens up the whole window of even more so that how the world is correlated to one another, and in particular how the US dollar is correlated to everything else. And so I'm going to put this chart up and talk through it for you and just explain what I understand that Keith McCullen was explaining on their morning show there at hedgeye.com this morning. And so here we go. So what you're seeing here is the inversion of U.S. debt, that is the black line, and the trade-weighted U.S. dollar index, okay? So the trade-weighted U.S. dollar index is in gray, and it goes back to, looks like 1974, up until here just recently. And what you see here, what I see and what Keith explained on the show today was that when debt goes up, or we increase the amount of debt the United States has, and in this case, the black line is inverted so that you can see the relationship to the US dollar, is that when the debt goes up, and we take on more debt, as we have seen in the last 12 months, the US dollar follows behind it. And so if you go and look at, looks like March of 20, and you see debt increased and went down as we went into 85, you saw the dollar devalue. And that ended up in 89, where the dollar devalued in relation to the amount of debt the United States took on. Go to March of 2002, and you see how debt increased, decline, in this case it's inverted, so it's declining, and then eventually the dollar followed along with that, okay? And then we see it, of course, where we are today in March of 2020, where we started taking on more and more debt, and we saw the Federal Reserve take on, basically their balance sheet expanded to $7.7 trillion or so. The United States deficit skyrocketed, and this inversion chart here of the debt indicates that the US dollar will continue to devalue. Now, over the last couple of weeks, we've seen an increase in the US dollar, and I'm put that chart up here, and what you see is a increase in the US dollar, but that increase has failed. And that failure of the dollar falling, and if you think about it over the last couple of weeks, as the dollar was rising, we had a period of consolidation within many indexes, many stocks. We've seen the crypto market, Bitcoin, Ethereum, not so much Ethereum, but Bitcoin in particular, and many of the others, take a dive down in relationship to the dollar rising. And so that's that opposite level of correlation. Today, as we look at this chart that Hedgeye provided to us, it shows that as we have spiked our amount of debt we've taken on as a country, our U.S. dollar will devalue. And so they talk a lot about inflation and that there's, inflation's in control. But if I remember a year ago, a gallon of milk, and since we don't drink regular milk here at the house, we use soy milk or coconut milk, the cost of that milk has skyrocketed. And I think you can attest to that when you go out to groceries. You're spending more today than you were previously. If you're building a home today, you're paying like so much more for that home to be built today because number one, demand, number two, the cost of lumber. Look at a chart of lumber. This is a form of inflation. And this chart that Hedgeye provided for me to provide to you, thank you very much, by the way, Hedgeye. This shows that as debt increases in the United States, it devalues our dollar. And certain sectors are going to do really well in that category. So, for instance, commodities are doing killer. I mean, I added to my corn position today. Pretty stoked about it. There are different countries that are killing it outside the United States. Anything related that goes up when the dollar goes down is going to continue to do well. And based on history, going back to 1974, we should see the US dollar continue to devalue. Now, at some point, this gets ugly and this doesn't really work out. And this is where I go to the Christmas trade. The goods that you buy for your kids and your friends, and the cost of those goods are going to continue to go higher. Incorporate the supply chain interruption we're having. It was interesting. I was talking to my brother-in-law this weekend who's in the oil industry, who can express how much pain he has gone through in the last year or so. He was telling me about how last year we saw a lot of shipping freighters get scrapped. And the reason they were getting scrapped is because of emission guidelines. And because the engines are basically burning just short of crude, straight crude oil, they're putting out a lot of emissions and a lot of pollution into the air. A lot of shipping companies scrapped a number of those older ships, which cuts down on the amount of ships in the ability to ship and bring goods to the United States. Throw in the fact that we are also short on containers to ship product from Asia, from China, Vietnam, Indonesia, over to the United States. Throw in COVID and people getting sick, you're going to have a supply chain shortage. And so the way this government is going to continue to push the market higher is through increased debt. I mean, you think about it, the spending bill that Biden has proposed is roughly $3 trillion. Where does that money come from? Well, it comes from, hey, we need $3 trillion, go sell more treasuries, issue more debt to the world, which then in relation also devalues the dollar. And we print more dollars. And as we print and print and print, we devalue our currency. Emerging markets historically have performed opposite of what the US dollar does. So an opposite correlation. The reason I'm telling you this is, my opinion is there are certain asset classes that are going to do really well for the remainder of this quarter. We'll see about third quarter. We'll see about fourth quarter. I talked about in my last video about the supply chain interruption and how I'm trying to get a new mountain bike, which I did find that mountain bike 1,500 miles away from me, which they won't ship it to me. I have to go get it, which is a whole nother story, which I'm actually excited about going to get. But there is a limited amount of components for bikes in the marketplace. There's a limited amount of suspension forks for mountain bikes in the marketplace because it's all sitting overseas. It has not been shipped here. So the way this government is going to continue to prop things up is to issue more stimulus checks, increase the debt as we're seeing, and devalue our dollar. And at some point, that devaluation of the dollar, well, it will actually turn into a negative thing for us. And that's where we could see a move from a growing economy, an inflationary economy, to a sinking economy, to a sinking inflation environment. And this chart, which Hedgeye provided and allowed me to post in this video, gives you a correlation relationship between US dollars and US debt. And to me, this is in the short term in my world is 3 months, roughly 90 days or so. Long term is 6 months because everything changes so much. But what this tells me is that certain asset classes are going to continue to kill it, continue to go higher. But what is at risk is the cost of goods. And at some point, probably this year, we're going to see where it's too expensive to build a house because the lumber costs are through the roof. It's too expensive to travel because gas prices are too high. And it's too expensive to buy little Johnny that toy because the cost to make that toy and the lack of supplies to make that toy and get it to the United States is under pressure. And that's where I look at the next 6 months or so. We need to keep an eye on correlations of how US dollars and debt work together, how they work when US dollars and if we see a slowing economy and we see what we saw in March of last year, where we saw people turning in their treasuries in exchange for US dollars, and we see a spike in the dollar. These are things we need to continue to watch. So, thank you so much, Hedgeye and Keith McCullen there at Hedgeye. I've got a link in the description at hedgeye.com. Go check them out. Super informative, super great content, and guess what? It's affordable. Yeah, they've done an incredible job. So hats off to them, and thank you, and God bless you guys at Hedgeye, because you've done an enormous amount for me as an investor and as a teacher of financial situations and just life in general. So anyways, go check them out. I've left the link in the description. But in the meantime, I'd like to hear your comments on this relationship between debt and US dollars and US dollars versus other sectors. So please leave a comment in the comment section. But also, more importantly, if you like this video, smash that like button. And if you would, subscribe. I'm trying to get my subscription numbers up. And I really appreciate all you do. And thank you for watching.